Good morning and welcome today for the Global Financial Stability Report press conference. Thank you so much for joining us today. I'm Mira Lewis with the Communications Department. Today we have with us Tobias Adrian. He's the Financial Counselor and the Director of the Monetary Capital Markets Department. Also with us is Nadir Abbas, who is the Deputy Division Chief, and Fabio Narlucci, who is the Deputy Director of the Monetary Capital Markets Department. So welcome. Thank you again for joining us. You can always send us your questions via WebEx or via the Press Center. And so before we begin, I'd just like to turn to Tobias for a few words. Tobias, this has been a rather complex environment in which you and your team have put together this report. Just spell out a little bit about how you went about putting this report together, what topics were of interest, and what challenges you and your team faced.
Absolutely. Thank you, Mira. The Global Financial Stability Report for this annual meeting has three themes: COVID, crypto, and climate. So let me go through the three themes one by one. COVID has been with us for more than a year and a half now. It has been raging around the world. And with the ebbs and flows of the pandemic, economic challenges have been raised around the world. The recovery from the economic headwinds and the global financial stability headwinds due to COVID are first order for all countries around the world. At the moment, we are seeing three major vulnerabilities. First of all, debt has increased. As countries were fighting the pandemic, they eased monetary policy, they expanded fiscal expenditures, and as a result, debt in the corporate sector, debt among governments, and in some countries in household sectors has increased tremendously. So high leverage is one vulnerability. A second vulnerability are stretched asset valuations. Easy monetary policy means that financial conditions ease, interest rates are low, and risk asset prices are rising. However, we do detect stretched asset valuations in some segments, and those could revert. The third vulnerability are capital flows to emerging markets. Emerging markets and developing economies have benefited tremendously from the ease of financial conditions. They have been able to access capital markets throughout the crisis, but there's a risk of a sharp reversal of capital flows to those countries. Finally, we are facing inflation that is higher and longer than expected, and that is a policy challenge going forward. Let me turn to the second theme of the GFSR, and that is crypto. Crypto valuations have risen more than tenfold in just over 2 years. And crypto valuations are highly volatile. Just this year, we have seen run-ups, declines, and run-ups associated with leverage in this important space. So we are taking a very deep look at the crypto ecosystem, and we're developing policy formulations for countries around the world. Finally, climate. Climate is an existential threat to the global economy. Many countries already are subject to climate catastrophe, and it is urgent for policymakers to develop policies around climate finance that can support the transition of economies to a greener and more sustainable path. Let me stop here with my opening remarks.
Thank you, Tobias. So we will now take your questions either via the Press Center, WebEx. Feel free to join us. So we already have some questions coming in, and I see one from the Press Center. This is coming in from Anthony Rowley from the South China Morning Post. He asks, what impact do you see rising inflation having on stock and bond markets?
Absolutely. We have seen that inflation has been above target in a number of countries. Not in all countries. In some countries, inflation remains below target. But in many countries, including some of the major economies, inflation has been above target. We see three main reasons for that. One are base effects as we're coming out of this pandemic. Last year, in the pandemic, prices dropped very sharply. For example, commodity prices dropped very sharply, and now prices are getting back to more normal levels. So those are technical effects that should dissipate over time. However, some of the increases in prices, in particular in commodities, have been higher and more persistent than what we had initially anticipated. And so while we continue to forecast that inflation is a temporary phenomenon with a reversion back to target in the vast majority of countries, there's certainly quite a bit of upside risk going forward to both the level and the persistence of inflation. Finally, we are seeing a lot of imbalances in supply chains. There are shortages of shipping, and those are driving up inflation in many countries. And we're also seeing that commodity prices are rising quite rapidly. So those increases could translate into core inflation, and central banks might need to act. In fact, some central banks have already moved to tighten monetary policy. This is particularly so in many countries in Latin America. In advanced economies, only 2 countries have tightened so far, and we will see what is happening to inflation going forward to see what monetary policy response is going to be.
Thank you, Tobias. I see there's a second question coming here from Pang Gao from Xinhua Agency. He asks, Fitch Ratings recently warned that political brinkmanship and reduced financing flexibility could increase the risk of a U.S. sovereign default. If the U.S. does default or the U.S. credit rating is downgraded again, what are the implications for the financial stability risks?
Yeah, thank you. This is a very important and very timely question. Many of you will have followed markets and followed political developments in the US where there is a debt ceiling. So that means that the US Treasury can only borrow up to a certain ceiling. And that generates uncertainty as to what is going to happen to the cash balances and to the financial position of the US Treasury going forward. At the moment when we're looking at market pricing, in the bill market, there is some increase in bill rates in early December when the debt limit is currently expected to be hit. But there's a potential for further uncertainty about the evolution, the political evolution. And, you know, that is certainly increasing uncertainty for capital markets in general and the US Treasury market in particular. So let me turn to my colleague Fabio to see whether he wants to comment.
Maybe just a couple of words. As Tobias said, attention now has shifted to a new deadline that has come out of the US Congress in early December. And so we have seen some adjustment of price in the Treasury bill market. There's many signs at this point, not significant imprint left in financial markets, either in the bill market or in terms of like Treasury securities. Now, of course, US Treasury security are the deepest, more liquid instruments and often the basis for pricing of financial risk. So potential default would be catastrophic in some sense because it will have ripple implication for other financial markets as well, especially at the time when we are recovering from COVID. And of course, markets need to be careful and pay attention to developments on this front.
Thank you, Fabio. I am going to now turn to WebEx. We have a question coming in from Lalit Shah from Press Trust of India. Lalit?
Yeah, hi. Thank you for doing this. I wanted to ask you about the inflation situation in India, how it is, how it has been impacted by the COVID-19 and the reforms that the government has taken now. And secondly, on the crypto, how the technology, means you have spoken about its fluctuation market, how the technology can itself be used for public good or governance globally. Thank you.
Thank you.
Thank you so much, Latiksha. Of course, India was hit very hard by the pandemic last year, and that did have adverse economic consequences. But the pandemic situation is improving in India, and with it, economics are improving. We have seen a tremendous rally in equity markets in India. Inflation remains within the target range of the Reserve Bank of India. And in fact, we have seen that India has scaled down some of its asset purchases recently. Now turning to the crypto assets, in India, as in many other countries, crypto markets are booming. Many individuals are participating in crypto investments. Of course, there's a tremendous amount of uncertainty about the valuation of crypto markets. And now crypto assets can be used to transfer money across borders. So authorities in countries around the world are taking policy steps and are in the process of developing policy steps to regulate crypto assets in a way that ensures investor protection, that ensures financial integrity, that ensures financial stability and monetary stability. So it's a whole set of policy steps, and different countries are taking different approaches. We are working very closely with our membership of 190 countries around the world in order to tackle these important policy challenges around the crypto ecosystem.
Thank you, Tobias. And just coming back to the questions, I'd just like to remind reporters, if you are on WebEx, please, it would be nice if you can turn on your camera so we can identify you easily. So let's turn to the next WebEx participant, that is Rich Miller from Bloomberg News. Richard, go for it.
Hi, thank you for holding this, and I didn't realize it'd be on camera. I would have been dressed up a little bit more. But a simple question, but given all the risks you see, should the Fed activate the counter-cyclical capital buffer at this time? Thank you.
Yeah, thanks so much for this question. Let me step back for a moment and explain what the countercyclical capital buffer is. Banks have minimum capital requirements, and on top of those minimum capital requirements, there are top-ups. So there's a systemic buffer and there's a countercyclical buffer. And so the countercyclical buffer philosophy is that it should be activated by policymakers, in particular in the US by the Federal Reserve, in order to protect the banking system and the broader economy against the cyclical buildup of vulnerabilities. What are these kind of vulnerabilities that we're seeing in the US at the moment? I think there are a number to list here. Number one, asset valuations are stretched in some segments of markets, so there's a risk of a sharp reversal of asset valuations, at least in some segments. Secondly, we do see that housing prices have increased tremendously in the US, in particular in some pockets around the US in certain market segments. And thirdly, of course, there's the global environment. We are still facing quite a bit of uncertainty, in particular with respect to the evolution of the pandemic and the evolution of inflation, as we discussed earlier. So now the question is, what is the right time to activate the countercyclical capital buffer? So this is a surcharge in between 0 and 2.5% of risk-weighted assets. At the moment, it's set at 0, but it could be gradually ramped up. And in general, that is done as the economy is expanding, as the financial cycle is booming. And there are certainly good arguments to turn on the countercyclical buffer at this time, but we have not taken an official position on that at the IMF. So I can't give you an official assessment at this point.
Thank you, Tobias. I am going to take another question that's come in from Evan Ingram. He's from the Asahi Shimbun. He's asking about real estate estate prices. So are there misalignments in commercial real estate prices in China that could increase downside risks to future growth and thereby introduce potential for sharp price corrections?
Yeah, let me start and pass to Fabio in a moment. So in China, there is the largest property developer, Evergrande, that has been facing challenges in terms of repaying its debt. It has debt of about $300 billion outstanding. The property market has been slowing down, and there has been a regulatory crackdown on leverage in that very important market for the Chinese economy. In our assessment, the Chinese authorities have the fiscal power, so the fiscal space, as well as the legal and institutional means in order to address this problem. Having said that, there are a number of financial stability worries that Fabio will go in more detail.
Yeah, so with respect to the situation in Evergrande and the property developer sector more broadly, I mean, so far contagion has been relatively limited. We have seen some broadening within the sector, for example, in offshore dollar funding markets, as well as a tightening of credit conditions for weak firms, as well as those are located in provinces with weak public provinces, with public finance. Authorities, as Tobias said, have the tools to address in terms of risk management as well as supporting the economy if needed. What we do in the Global Financial Stability Report is look at risk around essentially this general assessment, this baseline assessment. And so we identify a number of channels through which financial stress could be amplified. So one of them is through domestic financial sectors. So whether this is the exposure of domestic banks to Evergrande or broader property developer sector, not just at the aggregate level, but also at the level of individual institution. The exposure of what we call non-bank financial institution, whether those are wealth management product or trust companies, and also the extent of interconnectedness within the financial system, as well as what we call contingent liabilities, so guarantee that some of these companies may provide it. So this is the domestic financial channel. There's also a domestic macro channel. So if you see, for example, a slowdown in sales, which we have seen lately quite sharp, if we see a decline in equity in home prices, there could actually implication for collateral posting and the position of banks, for example. And so if you see, as well as obviously the local government, right? So if there is a slowdown of sales, the slowdown in revenues, they might provide support to local SOEs and so on. And so if that happens, there could be a feedback effect loop back into financial condition, a tightening of financial condition would become an amplifier. Then there's a third channel, which is through global markets, so spill over to the rest of the world. That could be through a broad deterioration of risk-taking. We have seen some of this in the month of September, for example, in global equity markets. It could be through the inclusion of China in indices, so the exposure of international investors, for example, in the dollar funding market, the freezing of the dollar funding markets offshore. And so those are potential channels as well. Of course, the tightening of financial conditions that might have implication for emerging markets. Now, again, as Tobias said, authorities have the tool to address both in terms of risk management as well as providing cushion to the economy should they need to. One important is that, of course, we have highlighted the need to delever the financial system in China. It's been in various global financial stability reports, one point policy recommendation we make in another IMF document. That should be accompanied by restructuring as well as reforms effort, as well as gradual phasing out of guarantees, as well as addressing weak SOE. So again, overall, we think the authorities have the tools, the risk remain, and if there is a need to support the domestic economy, it best be done by addressing the condition of household as well as supporting consumption.
Thank you. I think I'll go back to WebEx now. We have somebody from Egypt, Abraham Mahmoud from the Middle East News Agency.
Hello, thank you for allowing me to ask my question. I want to ask about COVID-19 already exhausted emerging countries and caused a rise in inflation globally and locally in Egypt too. So will Egypt be able to survive for a third year of such a situation in 2022, or would it resort to have a third loan from IMF? About the Egyptian Central Bank, it is under pressure to raise interest So do you think it will be able to keep the rates on the same level, or will it be pushed to raise it?
Thank you.
Thank you.
Yeah, thank you so
Tobias?
much for this question. So inflation in Egypt is within the target range of the Bank of Egypt. So in the most recent policy meeting, they did not make a change to policy rates. You know, in terms of the IMF, there was a second and final review completed in June, and the repayment of the first disbursement will begin in September 2023. So turning to your second question, that was about interest rates in advanced economies and more globally. So what we are seeing is that inflation has been above target in some countries and has been more persistent and higher than previously anticipated. That's particularly the case in the United States. In Europe, there has also been inflation that has come up. And there are three key questions for central bankers, for monetary policymakers, when they're looking at inflation and the path of inflation going forward. So the first question is, what is happening to inflation expectations? In most countries, there are surveys and there are market-applied inflation expectations. Both the surveys and market indicators are watched very, very closely. And for example, in the US, in the short term, there is an expectation that inflation is somewhat above target, but in the medium term, the expectation is that inflation will come back to target. In the euro area, for example, inflation is expected to get to target, but from below the target in the future. And in other countries like Japan, inflation is far below the target. You know, the second question is the nature of the inflation shocks. So are these inflation shocks that are going to go away, or are they going to last longer? And so there it really matters looking at the mechanics of what is generating inflation at the moment. So for example, there are shipping constraints in many parts of the world. There are constraints on commodities, and you know, that really depends on how this situation is going to evolve. The third part is looking at the labor market. While in the US and euro area employment remains below pre-crisis levels, you do see imbalances. So you see high vacancy levels in some sectors, but overall employment still below target. So the wage dynamics and to what extent the wage dynamics feed into prices is a third key question. So I don't know, Nassira, whether you want to add something on the Eurozone in particular in the inflation picture there?
Yes, so on the Eurozone, actually, you described very, very well where we are, actually. So the ECB new target, so it shifted to the symmetric target in last July. So now when you look at the market-based instrument measures, so we see that inflation is still below the 2%. So for instance, the five-year swap inflation that the ECB closely monitors, so is about 1.8%. So we are far below this ECB target.
Thank you. So just sticking to this ECB question, I have another question that's come in. So do we, the IMF, believe still that the ECB should maintain its accommodative monetary stance?
Yeah, okay. So the ECB has interest rates that are negative and that are expected to remain negative for some time. And the ECB is also conducting asset purchases. And for the moment, those asset purchases continue. So this is expansionary monetary policy. Interest rates are low and financial conditions are eased through the asset purchases. That is stimulating economic activity. The rationale is that employment continues to be below pre-crisis levels. Unemployment rates are high in many countries. And while inflation is somewhat above target in some areas of the Eurozone, there is an expectation that inflation will be back below target sometime in the future, and inflation expectations in the medium term are well anchored. So the bottom line is that our current assessment for the ECB is that the stance of policy is appropriate.
Yeah, absolutely. So, especially if we look at the driver of the current inflation, so we see that the increase we have seen very recently is more driven by actually the reopening of the economic and some supply disruption, as Tobias has highlighted at the very beginning of this meeting. So, so the inflation expectation remain well anchored, and I guess what we highlighted in this report is the importance of communication, and our main message for central banks is that they have to communicate very clearly their policy to give more clearance about clarity and about the policy monetary path actually to prevent any tightening of financial conditions. So it's very important, and it will also prevent tightening financial condition, as I said, but also to avoid unnecessary market volatility, which is very important.
Thank you.
So one point to add, perhaps, in the discussion of inflation is like emerging markets, which I think was the one part of the question at the beginning. So we have seen, obviously, headline inflation rise also in emerging markets, not only, but also the surprise have been the upside. And there's been a number of drivers. Tobias has touched upon the commodity prices. Other reasons have been, for example, food prices have been rising very, very strongly, very rapidly, and this has faced to be feeding also into core inflation. Now, that said, there are important differences across regions. So you see inflation seems to be more rising more rapidly, for example, in Latin America or in the EMEA region, when you see less inflationary pressure in Asia, for example. And that's true even if you look at the same time at core inflation as well as food inflation. There are very, very few countries in Asia where you see pressure on both fronts. Now, what do markets expect? Markets expect inflation is about, for the median EMs, it's now about 1.5 percentage point above targets, but they expect inflation to come back gradually over the next few quarters. Not only that, but also the medium-term inflation expectation based on survey seems to be within the target range of the central bank. I think, if anything, the risk is that if inflation continues to come back, it turns out to be temporary, but market pricing in more tightening of monetary policy, the real rates will turn from negative into positive, and you may see a tightening of financial conditions. So it's going to be very important to follow price dynamics and the extent to which this pressure may be temporary versus more persistent.
Thank you, Fabio. Well, I'm going to stay with inflation, and at the risk of sounding repetitive, this is an important subject. We have another question on inflation. Greg Robb from MarketWatch, he reiterates and asks, we, the IMF, are seeing that the inflation pressures are easing, but energy prices are now rising, and just in the last 2 weeks we've seen that. So does that increase our doubts in our forecasts?
Yeah, thanks so much, Greg, for this question. And let me clarify. Our expectation is that in the medium term, inflation is going to revert back to targets, both in advanced economies and in emerging markets. However, there are many risks to the upside to inflation, both in terms of level and in terms of persistence. So we might very well see that in some countries, inflation continues to increase for some time. But there are two important points here. So one is, in emerging markets, we have already seen a quite significant tightening of monetary policy. So real interest rates have increased on average in emerging markets. And so while inflation continues to rise, expectation is that inflation will come down, and that is predicated on the fact that interest rates have risen and are expected to rise even further. So it is taking the monetary policy response into account that is generating this drop in inflation expectations in the medium term. In advanced economies, the picture is a little bit different. So only two central banks, the Bank of Norway and the Reserve Bank of New Zealand, have tightened monetary policies so far in terms of raising interest rates. in the other countries, output gaps remain large, and inflation is, for the moment, assessed to be of temporary nature. It is assessed that inflation is going to come down. Of course, monetary policy is always state dependent. It depends on what is happening in terms of economic conditions, economic news. And what is embedded in the expectation of a decline of inflation is that whatever monetary policy response is necessary is going to be taken. So, for example, over the past month, we have already seen that the expected path of policy in some countries, such as the UK or the US, has been moved forward gradually. And as new economic data is coming out, these expectations about the path of interest rates going forward might well shift. And that is embedded in the inflation expectation, right? It's the fact that monetary policy is going to do what it takes to keep inflation expectations anchored and return back to target inflation in the medium term. Let me stop here.
Thank you. So now I'm just going to switch to emerging markets. We have two questions that have come in, one from El Economista and one El Financiero. So that's Yolanda Morales as well as Leticia Hernandez. So the questions are, I'm just going to combine them. It's about the share of the foreign-owned Mexican government securities have fallen to 18% in August. Now that's the lowest since October 2010. Do you see some risks if it it continues to extend this fall the rest of the year? And what do you see is behind this? Also, in general, what do you see are the financial risks that could be triggered by if Mexico returns to electricity generation methods that are different?
Yeah, thanks so much for these questions. So, the questions that are specific to countries will be addressed next week in the regional economic outlook. So the Western Hemisphere Department is going to have a press briefing, and you can ask, specific country questions at that point. So let me defer this question to next week.
Thank you. So, yes, all the regional press briefings will be next week, so please feel free to tune in, and we will have the information on our website. So we have a question on crypto, which is coming from Ricardo Leopoldo, and he asks, crypto assets have a nominal market value over 2 trillion. If this bubble explodes soon, do you see major consequences to other companies like Coinbase and banks that provide liquidity to those crypto platforms?
Yeah, thank you. The crypto market is indeed at a valuation above 2 trillion. The valuation of crypto assets is quite volatile. And there is the question of where this value is going to go. Crypto assets are different from, say, stocks and bonds, where investors are paying for future cash flows, right? When you buy a stock, for example, you get a dividend payment, and the ownership of the stock gives you a dividend payment for every year in the future. If you own a bond, you get coupons, and at the end of the maturity of the bond, you get back the principal. It's not the case with crypto assets such as Bitcoin. There's really no claim to future cash flow. It is based on the belief that in the future there are other buyers that are going to buy the crypto asset at a higher level. And so it's much more difficult to determine what the fundamental value of a crypto asset should be. Now, having said that, there are crypto assets that have a reserve, and those are typically called stable coins. So when you buy such a crypto asset, your proceeds are put into a reserve fund, such as cash or deposits with a bank, and you have a claim on that reserve if you own this particular crypto asset. So that's a very, very different construct from crypto assets such as Bitcoin or Ethereum. I would just note that volatility has been high. Traditionally, up until last year, correlations of crypto assets with equity markets and other risk assets was very low. But this year that has shifted. So correlations with equity market is increasing. And our interpretation is that more institutional investors are moving into that space. So this is generating this correlation in between equities and crypto assets. So that is making crypto assets potentially more systemic. So even though they're 2 trillion, this is still small relative to global asset markets, which are over 100 trillion in the aggregate. But for some countries, for some emerging markets in particular, the magnitude of trading in crypto assets and the share of ownership and the capital flows across borders associated with crypto assets, all of these things already amount to large numbers that can be macro-critical for some countries.
Thank you, Tobias. I mean, just staying with crypto, you just said that it was systemic. So this question sort of follows neatly after that. It's coming from Nikkei, Masahiro Okushi. He says that it seems that the US government is considering regulations on companies that issue stablecoins as strong as those on banks. How do you evaluate that? Do you see this regulation warranted? And I'll just also, here's another question, still staying on the subject, but it's more regional. And he asks, El Salvador made Bitcoin a legal tender in September. Do you see any issues with this? Does the IMF support this move?
Oh, thank you. So in our chapter number 2 of the Global Financial Stability Report, we analyze the crypto ecosystem in detail, and we list many policy recommendations. In our assessment, it is warranted for country authorities to tighten regulations around the crypto ecosystem. And one of the ways this can be done is by regulating wallet providers. So typically, an individual or as a firm to access crypto markets, you're using a wallet provider. And at that level, you should give your identity so that your identity can be used in order to make sure that transactions are legitimate. At that point, you can also regulate the degree of leverage and risk-taking that individuals are taking in this important market. And finally, you can take investor protection steps, right? At the moment, there's really no investor or consumer protection in this space. So regulators around the world are moving towards having more regulation of the crypto ecosystem. Now, let me turn to countries adopting Bitcoin as a national currency. In our view, that is a step too far. We would not recommend that countries adopt Bitcoin as a national currency for a number of reasons. The main reason being that it is highly volatile. So when you Bitcoinize, so to say, your country, you're importing the volatility of this crypto asset, and that could have macroeconomic consequences. There are a host of other issues related to financial stability, financial integrity as well. And we put out a blog post in July that is explaining all of these challenges.
So just one other question, just staying on crypto. I know you talked about countries, but since it's a question being asked, the People's Bank of China has banned all transactions related to crypto assets. So do you agree with this approach?
Well, different countries are taking different steps to the crypto universe. Forbidding transactions in a particular crypto asset entirely is, of course, one way to address risks. However, there are thousands of crypto assets out there. By some counts, there are more than 7,000 crypto assets out there. So if you forbid one crypto asset, of course, your population could start to trade in other crypto assets. And then the question is, do you want to outlaw all crypto assets or only some crypto assets? So there are some benefits to new technologies, right? So crypto assets are popular because they're using very powerful technologies, blockchain and distributed ledger technologies, and those can be used for many very good purposes, such as financial inclusion, lowering costs of doing financial transactions, allowing firms to access capital markets more cheaply. So our general policy approach is to advise our membership to take a policy approach that is minimizing the risks of new activities in crypto assets, but it's also taking advantage of the benefits of the new technologies. So it's balancing risks and benefits in an appropriate manner. Now, for different countries, that means different things because every country has a different institutional setup, a different legal setup, and different financial institutions. So there's no one-size-fits-all recommendation at this point.
So Tobias, I see we are almost coming to the end. We take one last question, and this comes from Heather Scott of Agence France-Presse. She is asking a big question, which I guess you can be a little more granular about. She's asking you, can you be more specific about the areas where you see financial risks building and how policymakers should deal with them? I guess this is sort of a global approach.
Oh, thank you so much for this question. And that really goes to the core messages of the Global Financial Stability Report. We are seeing vulnerabilities that are rising in three areas. There are stretched asset valuations in certain segments of risky asset markets. There are also deteriorating underwriting standards in some of those asset markets. So that is one pocket of vulnerability. Secondly, leverage is rising around the world among sovereigns and in the corporate sector. And higher leverage exposes countries and corporations to potential reversals in interest rates or widening credit spreads. Finally, there's the risk of capital flow reversals to emerging markets. So those are three vulnerabilities that are extremely important. How central banks are moving forward with policies in terms of interest rates and asset purchase programs is going to determine how financial conditions will evolve. And so the interaction between policy steps going forward and communication about those policy steps going forward, this interaction between the policies on the one hand and the vulnerabilities on the other hand is going to determine how global financial stability is evolving. There are difficult trade-offs for policymakers, trade-offs between inflation and real activity, and trade-offs between financial stability today and financial stability in the medium term. So both intratemporal and intertemporal trade-offs for policymakers. And so these are difficult balancing acts, and we are aiming to help our membership to take the right policy steps to make sure that global financial stability is ensured. Thank you very much.
Thank you very much, Tobias, and thank you very much for joining us today. Before we wrap up, I do want to say we will have the Fiscal Affairs Department conference this week and all our regional briefings next week, so please do tune in. Thank you again for joining us today, and stay safe.